Mm, Good morning. I don't know whether students will join or not, but I'll start the class. First live is going on. So today I'll start. What is investment? So we continue now. I don't know whether the response is down or not. So what is this investment? Investment, which is as a sacrificing what we have been sacrificing at present in order to get some returns in future. So here time and risk are going to play an important attributes for the investment. So many of the studies which have been related to the investment has been concentrated on the how the investment procedures has to be done, how the investment structures is to be done. So here this investment which has been conducted for the purpose of getting some expectations, means they have been expecting some returns in order to sacrifice something. They have been presently they have been sacrificing something. So the level of the risk which they have been facing by this investor has been estimated by some of the historical data with the help of some two approaches. So with the help of the two approach, they will be analyzing this investment. The first one is a fundamental analysis and second one is a technical analysis. So what do you mean by this fundamental analysis? A fundamental analysis is nothing but which is going to make use of earnings and dividend prospect of the firms, expectation of the futures, interest rate returns, and risk evaluation of the firms, which is going to ascertain and advocate stock prices. So it will be helping a very much things. So here technical analysis is that basically done for the identifying the recurrent of predictable patterns in stock prices, which is going to help it for holding something at present. They have been holding for some period of time, and they will be analyzing the trip strategy of a particular investment things, and they will be selling after any kind of a changes is going to happen in the market. So, what is the definition of these investments? What is the definition of these investments? Means it's the process of sacrificing something in present for the prospect of gaining something in latter, which implies that most probably there are three dimensions for this investment that is called as a today's sacrifice and time and prospective gains. For making the proper investments involving both side of risk and returns, an investor has to make a study on the alternatives, what kind of alternate alternatives available in the hands of the investor. So here, investment decision process, which is mostly related to the current consumptions, which is most related to the current consumptions that will be dealing with the investments. So here, which is where we can call in a simple term that is which is for depositing the money on various deposit schemes. We are money on various deposit schemes for offering some kind of a securities that may be what we call government securities, or that may be any kind of a private securities, which is that means we can invest something in real estates, or we can in something in bond shares, like that. So we can have things for investing some schemes which where the management is going to be indicating the opportunities for investing the money which is going to reach the predetermined or target that is called as a management. So here we are committing some money and resources today with the expectation of earning some returns and with the help of appreciation. So that may be bonds in mutual funds, in real estates, bank deposit, whatever may be the things. So whenever we are been considering the investment and speculation, always the investment will be having a moderate risk, whereas a speculation will having a higher risk. And here in investments, we can go for the long term basis, whereas speculation will go for the short terms. And we have been analyzing the technical as well as fundamental analysis in investments. Mainly, the speculation will be dealing with the market basis. So here, what are the certain objectives will be there for our investment means safety of the capital, safety of the capital, as well as the what we call a regular income and capital appreciations, liquidity, tax benefits, hedging against inflations, and all those things. Maturity, these are all the certain objectives of the investment which will be going to the investors. So here the various types of investments will be there, especially financial investments. Financial investments are those investments which is dealing with the shares, bonds, debentures, fixed deposits, insurance policies, etc. Real investment, nothing but your real estate, gold, silver, and machineries, lands. So different types of investment availables will be there for the investors like the equity shares, preference shares, government, securities, corporate bond, mutual funds, bank deposits, derivatives, etc. So derivatives maybe sometimes will be including of your mm, what is called futures, options, like that. So here in what is called in market we can analyze with the help of the what do you call mm, we can invest in stock market so that the investor is going to get a higher rate of returns. So here futures, forward futures, options, these are all considered as one way where the investor is going to be target something which is related to the m- market, where they will be analyzing the entire sources and how the market will be fluctuating, all those things. So whenever they will be going for the market related things, definitely the two things will be following. That is called as a risk and return. What is return? Return is reward as investors, which is going to receive on investing some money. It has two main components, that is income and capital gain. What is the meaning of income? It is a regular earnings, such as the dividends from shares, interest from the bonds, like that. Capital gain, that is nothing but the increase in the value of the investment. Example, if you are buying any kind of a shares and we are selling it for after sometimes for some profit basis, like based upon if you are purchasing some shares worth of rupees of 10 lakhs, and after some period of time we are going to selling it of 10 lakhs 30,000, so 30,000 will be getting some kind of a return. So risk, what is risk? It is referred as a possibility that the actual return from the investment which may be lower than that of expected, where the investors may is going to be. So here investor is going to suffer from losses. This risk is going to exist because of the future outcomes and uncertainties. And certain factor is also going to give an effect for these risks, like that economic changes, company performance, government policies, etc. With certain types of risk will be there. The first one is your systematic risk and unsystematic risk. What is the meaning of the systematic risk? Systematic risk is that risk which is going to affect the entire market or the economy, which cannot be avoidable through the diversification. Examples of systematic risk is what? Inflation risk, interest rate risk, economic recessions, and political risk. Unsystematic risk, which is going to affect a particular company or industry, which can easily reduce or eliminate it. Example, poor management decisions, labor strikes, product failure, financial mismanagement, entry of strong competitors. These are all the unsystematic risks which are in the hands of the management. Easily they can reduce. Relationship between this systematic risk and returns. So here, higher risk, high rate of return, low risk, low rate of returns. So here, whenever this risk and returns are going in the same parallel lines, investment decisions, investor is going to must balance risk as per his goals and the risk taking advantage. So here in different terminology, we can have a different types of things. What is the meaning of these? Whenever investor is going to invest in any securities, how is going to be diversify the risk? The diversification of risk is going to happen only with the help of the portfolio. What is the meaning of this portfolio? What is the meaning of this portfolio? It is a process of selecting, monitoring, and revising the investment in order to achieve goals. So here, instead of investing in one securities, we are going to investing in a number of securities. That will be helping for a systematic process of planning, constructing, and managing a collection of investments, which is called as a portfolio. So here, the portfolio may be consist of a stock, bonds, mutual funds, and whatever may be the things. The main aim of any investors is to get a financial goals with the help of considering a less risk as well as a time horizon of incomes. So here the main objectives of these portfolio management is maximizing the returns. How they are going to maximize the returns when the returns are been coming in the form of a income that may be in the form of dividends or interest, capital appreciations, whatever may be the things. So here they are going to select the assets with a good growth potential based upon the analysis of the market trends, company performance, and economic condition. So here diversification is always helps to the investor to spread the investment across the different assets so that the overall returns can be improved without taking any kind of a risk. Minimization risk. How they are going to minimize the risk? Every investment carries some level of risk, which that may be a market risk or credit risk or inflation risk. So here the portfolio management is going to help to reduce this through the diversification, that is investing in different industries, assets, classes, securities like that. So the combining the high risk and the low risk investment is going to always help the investors to minimize the risk. That is, they are going to balancing the equities. Ensuring the liquidities. How they are going to ensure the liquidities means when the investment are being easily converting into cash without having any kind of a significant loss. So here, for this, investor may need to funds for the emergency or the short-term needs. A good portfolio includes assets so that easily can sold in the market. Here, the portfolio manager is going to ensure some investments which is going to be help for liquidity that will be any kind of a sudden cash requirement will be there. Balance and growth income funds. So here, this balance and growth income funds is always going to increase the wealth of the investor over a period of time. And income is always going to provide a regular cash flows for the investor. This balance depends always on the investor's age, income, their needs, how the financial goals they will be expecting. Usually, young investors they were going to prefer more growth-oriented assets like equities and all those things. But retired employees, middle-aged persons, and family-related persons always prefer for the income-oriented assets like the bonds, dividends, all like that. So here, a careful analysis should be consisting of the by the investors in order to gain something in future, so that easily he can give a what you call a balance the things where he can going to analyze. So here, always the investor is going to be responsible for managing an investor's money. That means a specified financial goals for controlling the risk. So how they are going to be play the roles like analyzing the securities. Here, they are going to analyze the security. The securities may be a stock, bonds, and other financial instruments, which is going to use the fundamental and technical analysis. And they are going to select the assets, which is entirely based upon the analysis and investment objectives, and they are going to choose the suitable assets to include in the portfolio. They are going to diversify the investments by spreading the investment across different asset classes, industries, and regions, which is going to reduce the risk and avoid the overdependency of a single security. And they are going to be monitoring the performance regularly by reviewing how the investments are performing compared to that of benchmarks and objectives. Here, they are going to adjust the portfolio according to the need and requirement of the investors. So how this diversification is going to be help for the investors? What role they are going to play? How it is considered as important for investors? So definitely that will be helping for reducing the risk, stabilizing the returns, and interdependency of the investment. Next things, what are the factors which is going to be help? What are the factors which is going to influence the investment management? How the factors is going to be affect the investors? Most probably, generally, we are having two types of factor, that is internal factors or external factors. What is mean the internal factors? Internal factors, these are the factors which is going to be affect within the organization. External factors outside the organizations. When you want to analyze the clear view cut of the factors which are being analyzing this investment decision things, first we need to know about the internal factor as well as the external factor. Internal factor, the name itself is giving a description, that is here these are the factors which is going to be focusing on evaluating the individual securities bonds whether to decide to invest or not. So that factors maybe include the economic factor, What are the economic factors? The economic factors may be related to your GDP, which will be having a strong growth, inflation that will be helping to reduce the real returns, interest rate risk, which is going to affect the bond prices and stock valuation, monetary and fiscal policy. And some of the factors which is related to company, that is security specific factors, those are related to your earnings and profitability, cash flows, financial ratios, management qualities, and competitive position. Next, market factors. These are the factors which is most properly related to the market trends and any kind of investments or liquidity of the assets and market volatilities. Here, some other factors which are related to your risk factors. The risk factors mostly depend upon the classification of risk, how we have been categorized with the help of systematic and unsystematic risk. I don't know why people are not joining, but still I'm continuing the class. Mostly it is going to record it, I think so. So that's the reason. So here, what are the things we have been considering for the factors? Mostly the risk and return considerations, which is going to help for the risk tolerance and the investors' expected rate of return and diversification. And based upon the demographical profiles of the investors, specific factors like their financial goals, their age, their incomes, the time horizon, tax benefits, things. Assets allocations. How the investors are going to allocate the assets means with the based upon the combination of equities, bonds, cash, and real estate. What are the liquidity needs that will be helping for them? Mostly they will be having some kind of a things which easily convert into cash. Why? Because if at all any kind of emergency is going to happen, how they are going to meet all these things means with the help of this liquidity things only. These are the certain factors which is going to affect the investors. Mm, Next. Let me see. Yeah. Syllabus. Where is your syllabus? One. Next, what is investment decision process? So most probably investment decision process will be consisting of a 5 stages. First one is investment policies, investment analysis, investment valuation, construction of portfolios, evaluation of portfolio. So these investment policies will be again classified into 3 types, that is investable funds, objectives, and knowledge. What are investable funds? How the investors are going to be investing the funds with the help of savings or borrowings. What is the main objectives? Always when the objectives has been categorized, things here the investors are going 2 types. It is risk takers and risk covers. Risk takers are the high risk persons, and risk covers simply they have been concentrating on the safety of principles. And next, knowledge. Any kind of a market knowledge will be there for the investor, like tax shelters, brokers, potential real estate. They have to know all the alternative about the investments. Investment analysis. How the investors are going to analyze investment analysis with the help of 3 things, that is market analysis, industry analysis, company analysis. How they are going to consider the market analysis with the help of inflation, stock prices, and recession. And industry analysis will be done with the help of the major segmentation of the economy, which is going to add the value to the things and whatever may be the growth of the GDP, how the growth of the GDP and how the GDP is going to work. Next, company analysis. Company analysis will be done with the help of knowing the investors' knowledge, how the companies are going to earn, what is the profitability positions of the organizations, and how is the profitability efficiency of the organization, the capital structures, and the management decisions. With these analyses, they will be the investor is going to analyze the investment analysis. Next, investment valuation. The investor is always going to be evaluate the investor evaluation with the help of intrinsic value as well as the future value. What is the meaning of this intrinsic value? It is going to measure the book value or the real worth, which is compared with the of your market value. Future value is always going to measure through the statistical trends like the trend analysis. After that, they are going to construct the portfolio. Means whatever the portfolio they have been chosen, they have been diversified in a proper way or not. After diversification is going to done, they are going to evaluate the performance. How this evaluation of performance is going to done with the help of the performance appraisal as well as a revision. If at all any kind of a, mistakes are been identified in the diversification, simply they are going to revise their portfolio once again. Next, what are the sources of these investment decisions? Economic industry and industry data, market data, company data, and international data. These are the certain sources for your investment information. Economic and industry data where monthly abstract of the statistical of the selected industry like publication of CSO, economic indicators, national income, agriculture production, industrial productions, imports and exports. These are all the economic related things which is going to provide the sources for the investments for the investors. So not only this, they are also going to get the information from the budgets of the central governments, financial budgets of the governments, state governments like that. Here, RBI is considerably data which is going to provide the monetary related policies as well as the rates of the particular interest rates as well as inflation like that they will be providing. Next, market data. It is going to provide the data from the prices quotations, which is going to review of the stock market trends like stock market, whatever changes, daily changes, which is going to happen in the daily stock market, like their tax dates, dividends, announcements, dividends per shares, whatever may be the things. Some of the officially yearly book, like the dictionary of any kind of a stock related thing, publication of a stock market trends, every year capital issues, brokerage, stamp duties, etc. And not only that, they are going to get the market data with the help of the Economics Times, Financial Express, Business Standards, Investment Brokerage, and some of the consulting firms is also going to give some kind of a data for the investor. Company data. Mostly the investor is going to get the company data with the help of the company annual report prospectus like this. That means they will be getting some kind of a balance sheet, profit and loss of account for the period of 5 to 10 years. International, they will be getting with the help of your IMF, FDIs, lenders. So they will be getting some information with that also. So what are the I already saw that what are the factors which will be influencing these investment decisions? Amount of investments, minimum rate of returns, the expected rate of investments, ranking the investment proposals, and risk and return. So whenever we are going for the sources of risk, we are having a interest risk, market risk, inflation risk, financial risk, business risk, liquidity risk, country risk, and foreign exchange risk. So what do you mean by these? Interest rate risk. It is going to give changes which have been bond on the written on securities, which is called as interest rate. If interest rate is going to increase, there will be a decrease in the market value, vice versa. What do you mean by this market risk? When the values fluctuate due to the market factors, that is interest rate risk, equity price, foreign exchange risk. Next, inflation risk, which is going to always linked up with the interest risk. That will be hike in the prices in inflation always depend upon the economic positions of the country. What do you mean by this financial risk, which is always the debt financing financial position of the company, which is going to be careful about the amount which have been borrowed in interest rate is lower than that of a rate of a return on the securities. Business risk is nothing but the changes in the sales, which is going to affect the earnings of the companies in EBIT taxes, which is going to always reduce the firm's values, which reflect the shareholders' values. What is the meaning of liquidity risk? When the firms are not able to sell or purchase any product within a short period of span of time, is called a liquidity risk. It is always very much essential to maintain a liquidity positions of the organization. Country risk. When company faces many firms which is going to operate by IB and also called as sovereign bonds, which is includes of political, economical, etc. Foreign exchange risk, when a company country currencies, global market transactions, interest, borrowing, these are all the things which is going to affect from the outside of the country that may be related to a foreign exchange risk. Okay. So next, what do you mean by this? Investment versus gambling versus speculation. Investment versus gambling versus speculation. Investments always plans for the longer period of time and they will be holding for a few years. Whereas speculations, they plans for the short term period and hold for the only few days period of time. Investments will always deals with the moderate risk, whereas in speculation, the speculator is willing to take high risk because he will be earning the high return and as well as a risk also. And he is always going to borrow the amount from the personal borrowings. Whereas, excuse me, Investor is going to use his own funds and always avoids borrowing funds. Gambling is one kind of a typical things where the investors or the person are going to be investing for the thrill and excitement purpose, like horse racing, card games, lotteries. So they don't have any kind of a proper planning. High risk, high return, but also there is a thrill and excitement, which is entirely based upon unplanned, not scientifics, without having any kind of a knowledge of risk, how they are going to face such kind of a risk. So all these things will be dealing with the gambling. This is something about your investments versus speculations versus gambling. Mm. Next, exposed and ex ante returns. So this exposed and ex ante returns is mostly divided. This the exposed returns is mostly dealing with the historical data, which is related to the uh, past records. Ex ante is enables investors which is look into the future prospective from the investment, which is going to measure the return and risk for the benefits of something which is they are expecting in future. Mm. After this, I need to start the problem. So I want to share some notes, but notes don't show some notes. Okay. Camera. Mm. See here, these are some of the notes. I think it is recording, so easily you can understand how you are going to calculate the risk and return with the probability and without probability. I'll share one structure here so that easily you can share the screenshot. So this is formulas for your investment analysis, portfolio management with the probability and without probability. So I'm keeping for a while so that easily you can take such screenshots. Okay, so here I'll share some problems with you because right now students are not there. So that they can take some screenshots of my notes. Okay, please refer this single security with the probability notes. And here, this is a case for the two securities, and this is a formula for the two securities. So here, diversification of funds, the return formula R1 X1 plus R2 X2, the risk formula sigma 1 square X1 square plus sigma 2 square X2 square plus 2 into sigma 1 into sigma 2, sigma 2 correlation coefficient between 1 and 2. What is the correlation coefficient between formula of variable 1 and 2 into sigma 1 to sigma 2? What is covariance 1 and 2 sigma summation dx dy by n? What is covariance of x with probabilities pdx into pdy? This is a formula for the two security cases with the probability and without probability. Here, if you look at the question, a simple question, the risk and return has been given. Return on x and risk on x they have given. So easily we can with the help of doing the assume calculating the means. First we are going to calculating the mean. calculating the x bar and y bar, and we are doing the dx, x minus x bar, y minus y bar, and we are going to get these values. Then we are going to do the dx square, dy square, and dx into dy. As it is a case for the calculation of risk and return portfolio. So risk of securities, single securities formula, summation dx square by n, summation dy square by n, because we are having two securities. So after evaluating, we have got the risk on x security and risk on y security. Then we are applying in the formula written off portfolio. What is the formula for return on portfolio? R1 X1 plus R2 X3. R1 already we have evaluated. And the funds which are been diversifying equally. We are diversifying the funds equally because no information has been given. Risk on portfolio, we have been evaluating the risk on portfolio with the help of this formula. Sigma 1 square x1 plus sigma 2 square x2 square plus sigma 3 square x plus correlation coefficient 1 by 2. Already we have calculated with the available formula, and simply we are applying in the formula, and we are getting the risk on portfolio. So the return on portfolio is 8.75, and the return on portfolio risk on portfolio minus 0.76. This, with the help of WACC also, we can calculate the return on portfolio. WACC formula is nothing but your R1 W1. Okay. Here, this is three security cases problem. Return on portfolio R1 X1 plus R2 X3 plus X3. Why three security cases? Return on portfolio for three security cases. Formula please. Sigma 1 square x1 square plus sigma 2 square x2 square plus sigma 3 square x2 square plus 2 into sigma 1 x1 sigma 2 x2. Correlation coefficient between 1 and 2 plus 2 into sigma 2 x2 sigma 3 x3 correlation coefficient between 2 and 3 plus 2 into sigma 3 x3 sigma 1 x1 correlation coefficient 3 and 1. So with the help of small problem, already calculated value, these are all the calculated values. Simply we are applying these calculated values in the formula without solving anything. Simply we are applying in the formula without solving anything. Direct formulas values has been given. So we are applying in the return on portfolio and risk on portfolio. When we are applying return on portfolio 11.6, and we apply the calculate risk on portfolio 6.44. This is without solving, directly applying the formula. But when we want to calculate here with the help of the values, so they have given the three securities A, B, C. So first we need to calculate the return on each securities, that is A bar, B bar, and C bar, that is RA, RB, RC. So after getting, so we need to calculate the DA, DA, DB, DC. What is DA? A minus A bar. DB, DB minus B bar. DC, C minus A. DA square, DB square, DC square. DA into DB, DB into DB, DC into DA. So next we are going to calculate the risk on securities. Risk on A security summation DA square by N. B security summation DB square by N. C security summation DC square by N. After getting, we have calculated the risk of individual securities. When we got a risk of individual security, then we are going to evaluate the portfolio of the funds. In the problem, they have given the how the portfolio of the funds has been diversified. So A securities funds has been diversified 80%, 10%, and 10%. After that, we will evaluate the covariance of A, B, B, C, C. Formula for covariance sigma DA DB by N, sigma DB DC by N, sigma DA DC by N. After evaluating the things, we got covariance of AB, BC, CA. Next, correlation, we need to find out the formula for correlation. Covariance of AB by sigma AB, BC by sigma BC, CA by sigma CA. So after evaluating the correlation, we got these values. Then simply we are applying in the return on portfolio three security cases. So this is the formula for the three security cases. And simply we are applying all these values in the three security cases, and we got 0.17 is a return on risk on portfolio. So I'll just hold it for a while so that easily you can take the screenshot. Easy for you people, because no students are aware. Till now, no students are aware. Just wait. Okay. And this is beta coefficient. What do you mean by this beta coefficient? So whenever you want to evaluate the sensitivity of the market, we are going to evaluate the help of beta coefficient. The formula for the beta coefficient into unit summation x into summation x into summation r divided by unit summation x square minus summation x whole square. Another formula is covariance of x divided by risk on market share. So this is the formula for the beta. And some other problems are giving with the probability two security cases. This is a process to calculate. So here two securities information are given and probabilities and px, py, pdx, pdx square, pdy square, pdx into dy. These are all the things we need to find out. And simply we have to apply in the risk written on portfolio and risk on portfolio. Okay. This is with the probability and without probability. Some other exercise problems also there. If you want, you can please take down the screenshot. And this is a formula for the problem for the beta coefficient. So here they will give the information, number of years, written on market, written on portfolio. So what is the formula? N into summation x square minus summation x into n into summation x square minus summation x whole square. So first we need to calculate the x square, y square, and xy. When we calculate this x square, y square, and xy, simply apply in the formula and we'll get the 0.75 is the beta coefficient. Okay. So this is about your risk and return on portfolio with the help of beta also. So in this class, I have shared some notes and some problems also. If any students wants, simply they can get. I think live is going on if I'm not wrong. You will get the notes from there. Okay. Mm. So students, here I have shared some notes with you. If you want, you can go with the notes. Okay. It will available. I think today's class is done. Ma'am, can anyone please respond? Mm. Ma'am, also I have shared some notes. If it is possible, it will be available to the students. I think it's recording. So the class is done. Can I leave, sir? Hello? Okay, last 5 minutes. I'll wait. Then only I'll leave.